Welcome to FX Tech's comprehensive EUR USD analysis for November 17th to 22nd, 2025. This week witnessed dramatic volatility as markets navigated the aftermath of America's longest government shutdown and a stunning collapse in Federal Reserve rate cut expectations. The 43-day federal closure officially ended on November 12th, initially sparking a relief rally that pushed EUR/USD toward 1.1656. However, this optimism proved short-lived, as the probability of a December Fed rate cut collapsed from near certainty to just 50-50 odds. This hawkish repricing drove renewed dollar strength, reversing the pair's gains and highlighting the fundamental policy divergence between the dovish European Central Bank and the increasingly uncertain Federal Reserve. Today's analysis provides critical technical levels, scenario-based trading strategies, and actionable recommendations for navigating this complex environment. Let's dive into the details. EUR USD closed the week at 1.15105, down 1.05%, despite strong year-to-date gains of 9.90%. The weekly range of 1.1540 to 1.1656 delivered 116 pips of moderate volatility, reflecting the tug-of-war between political resolution and policy repricing. The 43-day U.S. government shutdown ended November 12th, marking the longest federal closure in American history. This resolution initially sparked a 0.48% rally as risk-on sentiment emerged and normal data flow prepared to resume. However, markets quickly shifted focus to Federal Reserve policy expectations. The probability of a December rate cut collapsed from near certainty to 50-50, driven by stronger U.S. data and hawkish Fed rhetoric. This dramatic repricing drove renewed dollar strength across the board, reversing EUR/USD's gains and pushing the pair back toward the lower end of its range. The fundamental policy divergence reasserted control over price action. Technical analysis reveals a critical battleground between 1.15414 and 1.1546, a swing area that served as a floor in October, ceiling in early November, and floor again after November 7th. This zone will determine near-term direction. Support structure includes 1.1576, defended by the 200-hour moving average on November 18th, the weekly low at 1.1540, Action Forex's primary downside target at 1.1467, and the critical 55-week exponential moving average at 1.1328. On the resistance side, the weekly high at 1.1656 represents a failed midweek peak, while 1.1670 marks daily Forex's bullish confirmation level. Psychological resistance at 1.1800 requires a decisive break for bulls to regain control, and 1.1917 represents the medium-term top with bearish MACD divergence. A break below 1.1541 increases sellers' control and opens the door to deeper correction, while a hold above maintains the consolidation scenario. 1 month ago, a December Federal Reserve rate cut was viewed as almost certain, with probability estimates approaching 100% as markets priced in a dovish policy pivot. Today, markets see just 50-50 odds for a December cut, representing a massive recalibration driven by stronger U.S. economic data and increasingly hawkish Fed rhetoric. This reduced rate cut expectation provided significant support for the U.S. dollar across all currency pairs, reversing earlier weakness that followed the government shutdown resolution. With the shutdown now ended, investors await the resumption of official economic data releases before making further dollar moves, creating a cautious, data-dependent environment. Even if the Fed does cut rates in December, the magnitude is likely to be limited, with expectations for a higher terminal rate than previously anticipated. This hawkish repricing of Fed policy creates a sustained headwind for EUR/USD, particularly against the dovish ECB backdrop. The European Central Bank's policy outlook stands in stark contrast to Federal Reserve uncertainty. In a November 14th to 19th Reuters poll, 84 of 90 economists expect the ECB to hold its deposit rate at 2% at the December meeting, with market pricing reflecting this overwhelming consensus. Looking further ahead, a 73% majority, 65 of 89 economists, expect rates to remain at 2% throughout 2026, with no further cuts priced in for 2025, and only marginal moves in 2026. This dovish commitment reflects a significant growth disappointment. In mid-2023, ECB staff projected cumulative growth of 3.6% by mid-2025, but actual growth has reached only 2.3%, a shortfall of 1.3 percentage points. While inflation is broadly on target, subdued growth justifies the accommodative stance. This policy divergence creates a structural headwind for EUR/USD as interest rate differentials move in favor of the dollar. Technical indicators present a neutral picture that masks underlying bearish structure. The 14-day relative strength index stands at 53 in neutral territory with mild bullish momentum but insufficient strength to drive a sustained rally. The MACD lines lean upward but await stronger impetus, while bearish divergence at the 1.1917 high, where price made a higher high but MACD made a lower high, suggests a medium-term top is in place. The 100-hour moving average was tested twice on November 18th, with sellers leaning against this level to prevent further upside, establishing strong intraday resistance. Meanwhile, the 200-hour moving average held support at 1.15828 on the same day as buyers defended this level. Pattern analysis reveals an ascending triangle breakdown on the hourly chart, a descending channel with lower highs and lower lows, and a three-wave corrective structure from 1.1917 suggesting the decline remains incomplete. Short-term scenario analysis reveals three potential paths with varying probabilities. The base case, with 50% probability, is range consolidation between 1.1540 and 1.1656. Pivoting around the critical 1.15414 to 1.1546 swing area. The strategy here is to buy support and sell resistance with tight stops, offering risk-reward around 1 to 1.5 while awaiting data clarity on Fed policy and Eurozone growth. The bearish breakout scenario carries 35% probability, triggered by a sustained break below 1.1540, with targets at 1.1480, 1.1467, and 1.1390, offering risk-reward of 1 to 2 to 1 to 3. Catalysts include policy divergence, technical breakdown, and stop-loss cascades. The bullish breakout scenario has just 15% probability, requiring a break above 1.1656, confirmed above 1.1670, with strong momentum, targeting 1.1740 and 1.1800. Risk-reward favors patience over aggressive directional bets in this choppy environment. Medium-term analysis identifies three scenarios with the 55-week exponential moving average at 1.1328 serving as the critical trend dividing line. The primary scenario, with 60% probability, is bearish continuation. The rebound from 1.1467 to 1.1655 is likely complete, and the decline from 1.1917 should resume as bearish MACD divergence confirms a medium-term top. A break of the 55-week EMA would signal the entire rally from the 2022 low of 0.9534 was merely a three-wave corrective bounce within the larger downtrend, with targets at 1.1467, 1.1390, and 1.1252. The alternative scenario, with 30% probability, is extended consolidation between 1.1328 and 1.1655 as markets await greater policy clarity. The low probability scenario at just 10% is bullish resumption, requiring a significant fundamental shift to break above 1.1655 and challenge 1.1917. Policy divergence strongly supports the bearish view. Long-term analysis reveals three scenarios with the 1.2 000 level, serving as the ultimate battleground. Scenario 1, with 55% probability, is downtrend continuation. Rejection at 1.2000/1.2019. The 38.2% Fibonacci retracement keeps the downtrend from the 2008 high intact, viewing the rally from 0.9534 as merely a corrective bounce within the larger bear market. A break below the 55-week EMA at 1.1328 would confirm this view, targeting 1.1328, 1.0500, and potentially new lows below 0.9534. Scenario 2, with 25% probability, is bullish reversal requiring a decisive break above 1.2000 to signal long-term trend reversal, targeting 1.2500, 1.3554, and 1.4000. This requires Eurozone structural reforms, U.S. fiscal crisis, or major policy divergence. Scenario 3, with 20% probability, is extended consolidation in a 1.00 to 1.20 range as fundamental stalemate persists. Eurozone structural challenges support the downtrend continuation view. Trading recommendations adopt a neutral to slightly bearish stance, recognizing that policy divergence and technical structure favor sellers, but awaiting clear breakout confirmation before aggressive positioning. Entry strategy includes 3 approaches. Primary is selling rallies toward 1.1620 to 1.1656 resistance, with stops above 1.1680. Aggressive is selling breaks below 1.1540 with confirmation. Conservative is waiting for breaks below 1.1467 and selling retests with stops above 1.1500. Risk management is paramount. Maximum 2% risk per trade, minimum 1 to 2 risk-reward ratio, and position sizing calculated based on stop distance. Profit targets include 1.1480 for taking 1/3 profit, 1.1467 for another third, while moving stops to break even, 1.1390 for the final third, and 1.1328 if momentum builds. Key events to monitor include December FOMC and ECB meetings, U.S. non-farm payrolls, CPI data, Eurozone GDP and PMI, and January 30th when the continuing resolution expires. Discipline and patience are paramount.